So do we have a live audience?
Yes, we do.
Okay.
Yeah, we're live and ready to go.
I'm going to keep it in this mode rather than full screen mode. It's easier for me to work the pointer. And I will have, what, 50 minutes now?
Yeah, till yeah, it's 8 after right now, so
Okay.
So 3:55 Eastern.
So did you send me the time as 10 a.m. Central Time?
No, I said 3 p.m. Eastern time.
3 p.m. Eastern. Gotcha. Sorry about that. Okay, so ladies and gentlemen, I'm sorry for being late. In all the hundreds of webinars that I've done, this is the first time I've ever been late. So I have some really good stuff for you today. I did a webinar called Cheap Stocks, Big Bucks, Swing Trade. The reason I chose to do this webinar is it's a methodology that I've been using for a couple of months now, and it's been very effective. And I think we want to take advantage of some things that are happening in the markets that have never happened before. One of them is zero commissions. The other one is the fact that many cheap stocks, by which I mean $15 a share and lower, my definition, are making big percentage moves during the day. So for example, it would not be unusual for a $15 stock to move $2 or $3 in one day, or it would not be unusual for a $10 stock to move $1.50. So in terms of percentages, it's really big. And given the fact that you can do this at zero commissions is very significant, because it means that with a relatively small account, you can do a lot of big trading and pay zero commissions. So mind you, I'm not talking about day trading. I'm talking about short-term and swing trading. So what I'm going to do is this. I'm going to show you the methodology. It's completely objective. It's completely rule-based. No interpretation, no analysis. I'll show you everything you need to do. I'll give you some very specific, real examples, as well as trades that are in process right now. So let's get through some preliminaries. I can't do this for you. I can show you the methods. I can show you examples. But the real issue is this. Who's going to do it? From what we know about the discipline of traders is this. They find a methodology. They see it working, but they try to make it better. They try to figure out something that's going to make it work better. Well, the bottom line is this. We're not perfect. We don't have perfect methods. But if we can be correct 70 to 80% of the time, and most of all, if we can maximize the profit when we're right and manage the risk when we're wrong, that's really what the whole game is about. So, a couple of preliminaries. Everything we do is going to be specific. It's going to be clear. Anybody can do it. You can start with a small account. This is not about options, although you can use options if you want to do the trades that way. But if you do options with what I'm showing you, you will need to do options that are at or in the money. You're only going to hold them a few days in most cases. You can come back and read the presentation later on and pick up on it. What I want to do is I want to focus on some specifics and give you examples one after another after another. So, a couple of rules. We're going to trade stocks that are in the price range from $3 to $15 a share. Why that range? Generally speaking, stocks that are under $3 a share won't be around for too long. They won't have the same kind of percentage moves. Usually they will be low volume stocks and you want to avoid that. So I set some arbitrary limits here, $3 to $15. And if you have a scanner, you can scan for these stocks very easily at the end of the day. We're only going to trade stocks that are actively traded, by which I mean at least 1 million shares a day on average. You can also do it on the basis of valuation, by which I mean take the number of shares outstanding, multiply by the price, and trade stocks within a certain valuation range, whatever you want. But remember, you want to have at least 1 million shares a day, not because you're going to trade a 30 or 40,000 share position, but because you want to be able to move in and out of the stock quickly and easily without having to use limit orders or market orders that are going to get you into trouble with a bad execution. So all decisions are going to be based on the daily chart. We're only going to trade stocks that have at least 1 year of history. And by the way, all of these can be programmed into a scan. We are not going to trade different time frames, by which I mean you're not going to look at a chart and say, well, the daily chart is doing what I expected it to do. The daily chart is working according to the rules. But what's the weekly doing? What's the monthly doing? Don't do that. It'll be confusing and it's too much information. We're not going to consider earnings reports, news, or the underlying market trend. We're not going to overweight. Example, last month, the month they're standing, we had some very, very good trades in airline stocks. But most airline stocks were doing the same thing at the same time. So it was not impossible that we'd have maybe 7 or 8 possible trades in 7 or 8 different airlines at the same time. We don't want to do them all because then we're overweighting, by which I mean, if we're right, we're going to be really smart, we're going to look good, we're going to make a lot of money. But if we're wrong, we're going to be a villain. So don't overweight, try and diversify. We're never going to risk more than 50% of the price of the stock as the stock. So example, let's say that you've got a $10 stock and the stop according to the method would be more than $5. We're not going to take that trade. So it's the risk management methodology. We're going to trade the same portfolio of stocks. In other words, find some stocks that suit your criteria in terms of price and look at them every day or scan that file every day and get the trades that you want. And as I said before, we're never going to consider the news as part of the decision-making process, but many times the news will help us get into a trade. So let me go forward. Everything we do is going to be based on my trading model, setup, trigger, and follow through. I'm going to show you the setup, I'm going to show you the trigger, and I'm going to show you the follow through. Really, really simple. And remember, there's nothing here that you can't do on any of the trading software that you have. So we're going to be using basically 2 indicators. The so-called moving average channel, which I'll explain, and the momentum moving average, which will be our setup or our trigger. You're going to get specific examples from me momentarily. We'll come back to this later. So here's a chart. Here's the full picture. I will explain everything to you on the chart. And remember what I said. Everything here can be done on practically any program, by which I mean TradeStation, Trade Navigator, Ninja Trader. You can do this on any of the, you can do this on E-Trade. You can do it on, I think, or Swim. So any platform is capable of doing this for you. So let me explain to you what we have. On the top of the chart, we have, and this is a daily chart, we've got the red line here. That is a moving average, 10 days of the high. What do I mean by that? Instead of looking at moving averages of closing prices, which is what most people do, we're looking at the moving average 10 high. In other words, the computer is taking the last 10 highs, adding them together, dividing by 10, and that's what the red line is. The line below it, the green line, is an 8-day moving average of the low. So it's 10 high, 8 low, right over there. Why those numbers? Well, everything I do is back tested, going back many, many years. And this is the combination that works best with this methodology. So the top of the chart, 10 high, 8 low. You'll notice I'm not using candlesticks simply because they confuse me. Too much information. So I use bar charts, but you can use candlesticks. The outcome is going to be the same. At the bottom of the screen, and listen carefully, the green line is momentum 14. In other words, I'm taking the 14-day momentum, and then I'm taking a moving average of the 14-day momentum, which is the red line. So let's talk about that again. The green line, momentum 14 of the close. As I said before, any software can do this, piece of cake. But here's the part you're going to have to figure out with your software. I want to take a moving average of the green line. In other words, a moving average of the momentum. So this red line over here represents a 14-day moving average of the green line. Again, Very easy to do, completely simple mathematically, not complicated, no secret, but you have to figure out how to get your software to do it. We do have the ability to get you the code for TradeStation, Trade Navigator, Thinkorswim, and so forth, and NinjaTrader at my other website called JakesTradingStrategies.com. So what's next? These indicators form the setup. We now need a trigger. And this is very, very important. Because these stocks are so cheap, and some of them are getting cheaper and cheaper, and because there are so many stocks that will get cheaper, we don't want to be short. And that's a very, very specific, unalterable rule. We will never sell short cheap stocks using this method. Now, please pay attention. I'm not saying we won't be short. I'm not saying we can't be short. What I am saying is this. For this particular method, we are only going to take long trades. If there are no triggers and no setups, there won't be any trades. It's really, really simple. So let's talk about the conditions. You will notice right over here, the green line, which is momentum 14 of the close, goes above the red line. That is the first indication that there's likely to be a change in trend for this stock. But that's a setup. We need a trigger. A trigger occurs when we get 2 consecutive price bars that are completely above the top of this channel. So even though it looks like these lines may be touching, the numbers show that they're not touching. So you have 2 consecutive bars above the top of the channel, and that's the trigger. At this point, the trend has now officially turned up according to my methodology. You now have 2 choices. You have actually 3 choices. I'll tell you what they are. Choice number 1, buy the stock immediately at the end of that day. Target, you're going to take the largest range of these 2 days, add it to the close of trading on this day, and that becomes your target, which was hit right over here. That's choice number 1. Choice number 2, wait. And this is the most conservative choice, the one that I prefer. Wait for what? Wait for the price to come down to the bottom of the channel, which is a number. Buy it at that number and take profit at the top of the channel. There is the swing trade right there. Now remember, this doesn't look like a big amount of money, and in fact, it's really not. The big money comes in the position size. So even though this move may only be about 25 cents per share, multiply times 500 shares or 1,000 shares, which is still not a great deal of money considering it's a cheap stock, and you've got something really good going on. There's another pattern, and that pattern is what I call the 5 consecutive bar pattern. You will notice 5 consecutive bars. There has been a strong tendency with this methodology that when you have 5 consecutive bars completely above the top of the channel and the lower indicator, momentum moving average, is above, in other words, in buy mode, you have a very strong tendency for the range of those 5 bars to be achieved as a target. So one more thing. I realize I'm throwing a lot of information at you. You will do best if you come back and re-listen to the webinar because it will help you understand what I'm showing you. Please remember, everything I'm showing you is 100% rule-based. You never have to look at a chart and say, it looks like it wants to go higher. You never have to look at a chart and say, I think it should come down to about here. You never have to look at a chart and say, I hope it goes higher. The answer is completely clear. So we have again, buy setup, buy trigger, entry, or entry, target, or wait for the 5-bar pattern, buy at the end of the 5th bar, and wait for the target to be achieved. The target being the range of the 5 bars from the lowest low to the highest high. It's that simple, but what else? The stop loss. You're going to take the largest range of these 2 days, you're going to double it, and that becomes the stop. So you have some choices to make. I always opt for the conservative choice, by which I mean I'm going to wait for the bottom of the channel, because even though I may miss the move, I will gain a lot of accuracy. And even though the move may be smaller, I will gain a lot of accuracy and decrease my risk. So let me go with the next chart. Here we go. Same chart. We left off on the same chart right over here when it first hit the bottom of the channel. So let's go back to that point in time right over here. So there's your first setup, trigger, target, target hit, right over here, entry point, exit point. You get another entry over here, another exit over here, another entry over here, another exit over here, and so on and so on. So you can see that just in a very short period of time, this very actively traded, relatively blue chip, old company that trades heavy volume, allows you to get excellent price executions, has given you numerous opportunities to make some money. But let me show you something that's even more important. It doesn't matter that the lower indicator turned negative over here, because that was just a setup. We needed to trigger a downtrend with 2 consecutive complete bars below the bottom of the channel. That did not happen. So here on the left, sell setup, sell trigger. Big downtrend, but remember, we're not going short with this methodology. Now the most important point. The big money is made in the big move. So assume, for example, that you have put your position on right over here. Where did this number 687 come from? At the end of this day, what did you know? You knew that the trend was up. You knew that there was a trigger. You knew that you wanted to buy at support. 687 per share was the price as of the end of that day. If you placed an order to buy it the next day, you would be filled very close to the low of the day. On the end of that day, you knew your target right over here, or the largest range of these 2 bars, and you placed your order. But assuming that you got filled and got some money, reached your target, if you placed your stop at your original entry price, 687, right over here, on your last position, in other words, a break-even stop on part of your position, as of the end of this chart, you would still be long. The point I'm trying to make is this. The big money is made in the big move. This stuff over here, swing trading the channel, it's chicken feed unless you trade a reasonable number of shares, at least 600 shares. However, the big money is made in the big move, and as you will see from some of the charts that I'm going to show you, many of these go on to make very big moves, and with your original position still in place, you've taken part of that big move, and there's a trailing stop, which I will teach you. So let me go to the next chart. Same chart, closer look. So let me run through it. 5-bar pattern right over here. 2-bar pattern right over here. Buy trigger, exit. Buy trigger, exit. Buy trigger, exit. Again, the swing trade situation on this stock, and as I said before, very, very well-known stock, not involved in any high-tech business or anything like that. It's not going to be the kind of stock that opens $2 lower because its drug was rejected. Let's go to another chart. So this is the same chart, Alcoa. Let's go to Macy's. What I want you to see is this. I want you to see that the pattern is very consistent. It's not always the same, but the rules are the same. In other words, buy setup, suggesting a bottom, take no action yet. Buy trigger, now in an uptrend, take no action yet. Buy the bottom of the channel, first opportunity, and you know what that number is. So that number will always be known to you at the end of the day. In a little while, I'm going to show you some current charts so you see how things are shaping up, as well as some trades that are on schedule for possibly as soon as tomorrow. So here's Macy's again. Same situation I told you about before. And what happened? Right over here, you had your first opportunity to go long. You hit your target. Let's assume you got out. The next day, it opened below the bottom of the channel. You got back in again. You measured the largest range the previous day, previous 2 days. You doubled that, your stop goes down here. Time passes. The trend does not turn lower. You get 2 bars back above the top of the channel, and you're still in an uptrend. Let's go to another chart. Silvergate, sorry about that. Look at the pattern. Buy setup, and you're waiting and waiting and waiting, looking at it every day. Buy trigger. In this case, if you were aggressive and you took the largest range bar of these 2 days and measured it, that was your risk. If you were willing to take that risk and buy it at the end of the second day, you would not have been stopped out, and you would have reached and exceeded your profit target significantly over the next few days. But if you were taking the conservative approach, which I emphasize again, that I much prefer, you would have missed this trade entirely. No problem. The good news is there's always going to be another trade. In fact, the better news is there's always going to be a lot of trades. So here's that Silvergate again. Let's talk about it in detail. Silvergate. Let's assume that you took the aggressive approach. Buy setup, buy trigger. You bought at the end of this day or the beginning of the next day. You took the largest range bar. You added it to the close of trading. You projected target number 1, target number 2, because the market tends to move in sections, in rhythms that accompany the range of that bar. So you will find frequently that bar, which is $170, repeats itself here as a target, and here, then again as another target, and again as another target. And so you're making big money, but you did that by being aggressive. If you were conservative, you missed the move. Now, what are you going to do with that big profit? You reached 2 profit targets of $117, and as I said before, take your time, go through the video. I'm going to offer you 3 additional, in fact, this webinar was so popular, I was asked to repeat it 3 times with more up-to-date information, which I did. So I'm going to offer you the 3 webinar package at a very cheap price if you're interested. Otherwise, you can go through this repeatedly until you learn it, because there's a lot of moving parts, but they're not complicated. So what is this red line? This red line is the trailing stop. So once you've reached several profit targets, taken a bunch of money off the table, your job, you want to remove all additional risk or most additional risk from the table. The way to do that is to use the trailing stop. What's the trailing stop? The trailing stop that I found to be very effective is a 3, now come on guys, we're already doing this here, is a 3-period moving average of the low. And that's the red line right over here, okay? So every day at the end of the day, I know my stop, and I need to close, I repeat, close below that stop. So in other words, at the end of this day, being in a long position on my last trade, I'm placing a trailing stop. My trailing stop is I must close below this number. So you can see that I'm giving it plenty of room, but at the same time, I'm not giving it too much room because I want to keep my profit as much as I can, but I also want to give the market a lot of room to move higher because some of these will be explosive and continue to go much, much higher. So let's go on to the next slide. Go away, Top Gun. Go away. Let me get rid of this. Some of these people just continue to advertise, don't they? Okay, let's look at Weight Watchers. And what I want you to see by this is the repetition of the same pattern. As I said before, it's not going to be exactly the same all the time in terms of what it looks like. But in terms of the rules are always the same. And if you apply the rule, you will find that what I'm teaching here is very different than what you will learn from most people. Because most people aren't real traders. I trade what I teach, and I teach what I trade. So there's a specific answer to every question. So let's look at Weight Watchers. So Weight Watchers in a big downtrend, blah, 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 continues down, down, down. And then we get a buy setup, momentum, close 14, crossing above its moving average. We're waiting. Waiting for what? Waiting for a trigger. Buy trigger. The buy trigger turns into a 5-bar pattern. If we measure the range between the highest high and the lowest low during this 5 bars, consecutive bars, you will reach that profit target a good percentage of the time. It's an aggressive target, but let's deal with that later. But at this point right over here, I know 2 things. I know the trend has changed, and I know I want to be a buyer. I also know exactly where I want to buy, which is the bottom of the last completed bar. Once I know that, I know my stop. I also know where I want to take my profit, which is the top of the channel right over there. Doesn't look like it's really big, but it turns out to be really big based on the size of the position you're trading. One more thing. I'm not suggesting that you need to trade a big position. I'm not suggesting that you need to trade 1,000 shares. You can do this with 100 shares and divide it into groups of 3 if you're a beginning trader. Don't take more risk than you can afford. So here's a closer look at what we saw, a little bit magnified. The buy setup occurred somewhere to the left of the chart. The trigger occurred with the first 2 bars. If you took that trigger immediately at the end of that second day, over the next few days, you reached your target. But if you waited and took the conservative approach, which as I said before and will say again, you're waiting for the bottom of the channel, every day you know what that bottom of the channel buy number is. And you place an order to do it, to get in. Now let me give you a little tip. Since I know this number for this day was right over here, I can look at the pre-opening market and see where the stock is trading right now. Sometimes that stock will be trading below your buy number, in which case you don't want to put an order in, you simply want to buy it at the market on the opening and get a better price execution. Sometimes it will come right down to your price and not fill you. So if you want to, you can apply what I call the universal fudge factor and increase your order by 1 or 2 cents. It won't cost you much in the long run, but in the short run, you get filled more often. Because remember, I'm not the only person doing this. There'll be a lot of people doing this who learned it from me. But that doesn't mean it's not going to work, especially with actively traded stocks. So assuming that you got filled right here, you knew your stop, twice the range of the largest bar in the previous 2. In addition to that, you knew your target, which was right over here. And right on the opening the next day, you hit your target. The trade is over in terms of the danger zone. You took some money off the table. You began to trail a stop, locking in a percentage of your profit. Okay, so let's go to the next chart. So then what happens to Weight Watchers? Eventually, it reaches its 5-bar target, which is right over here, and it reaches it right over here. And that's where the big bucks is. You'll also notice the trailing stop. The trailing stop is only implemented after I reach my first target. And you can see the trailing stop remains in effect over here. So a question that nobody asked. What happens if the green line goes below the red line? Nothing. Because the green line going below the red line, in other words, momentum going below its moving average, is meaningless unless it's accompanied by 2 consecutive bars below the bottom of the channel. So let's do this. Let's look at another one. Overstock. And what I want you to see, as boring as it may be, is the consistency of the pattern. Buy setup, buy trigger, entry, target, target 2, big move over here, which you capture with the trailing stop. And how does that look? Looks like this. You reach your 5-bar target, you put in your trailing stop, and remember, this zigzag line over here, this stair step line over here, is not implemented until after you reach your targets. So it's not going to be there all the time. It's only going to be there after the target, which is when it becomes active. And in this case, you'd be stopped out right over here. You did miss part of the move, but remember what I said. This is not a perfect methodology. It's simply designed to grab a lot of good moves very quickly as a swing trade. Let's do another one. Here's another one. And again, I want you to see the consistency of the pattern. Buy setup, buy trigger, 5-bar pattern, buying opportunity, right over here. So let's talk about this one. At the end of this day, you knew the trend was up. You place an order to buy, you're filled shortly after the open, and immediately you hit your target the very same day, and you get another buying opportunity over the next few days, and then you hit your target again. After that, you can put in your trailing stop, which is the 3 MA of the low, as I'm showing you here with the red line. Let's go to the next chart. Caution. Sometimes you will see stocks that are trading extremely low volume. You may be tempted to trade those stocks. All I can say is this, you're on your own. Sometimes these stocks will give you dramatic triggers on my methodology, by which I mean 2 complete bars above the top of the channel, buy trigger, no sell triggers. Over here you sell setup, but no trigger. And then you get this explosive move on volume that moves from virtually nothing to about 150 million shares. I think it's 150 million shares or more. 180 million shares. Even though these look good on charts, try to avoid them. Most of these moves will come on medical stocks, biotech stocks, cheap stocks that have drugs in the works that are being approved or disapproved. And even though it's exciting, when you look at them with 20/20 hindsight, and even though they may show up on your scan, try to avoid them. Let's go on to the next chart. Caesars. Again, set up over here to buy. You're waiting. Trigger right over here. 5-bar pattern right over here. Measure the range from the highest high to the lowest low. Add it to the last bar close. Profit target achieved. 3 MA low goes into effect. And that's the whole story right there. It couldn't be more simple. Let's go on another one. And by the way, I've got a lot of examples for you. My goal to teach you something really specific. Your goal and your commitment, if you like my work, try it. Don't believe anything that I or anyone else tells you in this business until you see it for yourself. This methodology might not be right for you. It might be perfect for you. But I'll tell you one thing that's important. It is crystal clear, never subject to interpretation. Example. Let's say that you realize this stock, you just picked up this stock on your screen on this day, right over here. Let's talk about what you know and what you don't know, and compare it to what you know or don't know using other methodologies, by which I mean, At the end of this day, the last bar on the chart, you know a couple of things. Number one, excuse me, you know there's been a trigger to buy. You know there's been a setup to buy. You know where you want to buy, the green line. You know what your stop will be. You know what your target will be. Don't interpret. Don't go to the news. Don't look at another indicator. Just go with it and say, hey, I'm okay with the risk, or I'm not okay with the risk. If you're not okay with the risk, the trade's not for you. It's really, really simple. Let's go to the next chart. The same one we looked at before, but now we see the rest of it. Again, buy setup. I know it's getting boring for you. I'll spice it up shortly. Buy setup, buy trigger, entry, trailing stop goes into effect. And what I want you to see is this. All of these days go by, and until this day right over here, where my crosshairs is, you never closed below, and I repeat, closed below that moving average trailing stop. And that's the power of this stop. So if there's only two things that I can teach you today. Number one, the strategy model. Setup, trigger, follow through. Number two, the trailing stop procedure, which will help you regardless of whatever method you trade. Let's go to the next chart. Again, same pattern. Now you might say, well, I know what Jake did. He went through and he found a bunch that work. I'm going to show you ones that don't work as well as ones that do work. But the key to this, as well as understanding the methodology, is this. Look at the same stocks every day. Go through, find ones that appeal to you in terms of their volume, that meet the criteria I stated before. Excuse me, sorry about that. That meet the criteria I stated before, that fit your budget, that fit your volatility, and trade those stocks consistently, coming back to them over and over again. Another one, same pattern. Buy setup, buy trigger, 1, 2, 3, 4 opportunities, 4 days in a row to establish your position. And remember this, most of the time, these trades will hit their target very quickly, or they will stop you out very quickly. Either way, it's good. If you get stopped out quickly, fine, you're managing risk. If you hit your target quickly, that's even better because you're taking some money off the table and giving yourself an opportunity to participate in the bigger move. And here's the same stock with a trailing stop. Let's go on to the next one. Smile Direct Club. So here's a stock that I've traded a lot, but I want you to check something out. Buy setup, right over here, and we're waiting and waiting and waiting, no trigger. Over here at the end of the chart, the buy setup went away right over here because the green line crossed below the red line. So this one, even though it's on my watch list, it's not on my screen in terms of anything that I want to do. Then what happens? Things change. So the end of the chart we just looked at was right over here. And then finally, we got our 2 bars above, we got our setup and our trigger, and the stock takes off. And again, if I'm waiting for the bottom of the channel on this stock, excuse me, I didn't get an opportunity. So again, you have to decide how aggressive you want to be. Go to the next one. 2 bars above the top of the channel, Williams above its moving average, buy setup, buy trigger at the bottom of the channel, 5-bar pattern, 5-bar pattern achieved, numerous opportunities to buy the bottom of the channel, and then the trailing stop if you wanted to. Excuse me, ladies and gentlemen, sorry about that. I talked about the airlines before. The airline is very, very simple. Again, here's the situation. Remember, it's all about patience, and do wait day after day after day. It's okay because it's going to turn out good if you're patient with it. Here it is. Buy setup, finally a buy trigger, and you wait and you get filled and you're rewarded for your patience. And I'm sorry about the noise here. I'm at home and I've got some animals outside that are going a little bit crazy. Let's go to the next chart. WPX. And what I want you to notice is this. Even though many of these stocks are not in the same industry group, the patterns are the same, by which I mean buy setup over here, buy trigger over here. Now, one more thing. Is it possible that we get 2 bars above the top of the channel before the lower indicator turns? Sorry about that. It is possible, but not very frequent. So again, the buy setup, the buy trigger, the opportunity. One moment, please, ladies and gentlemen. That's one of my dogs going a little bit crazy for my pool technician. Okay, here you go. Buy setup, buy trigger, opportunity to buy the bottom. Let me kick my dog out of the room here. Hold on a minute, please, ladies and gentlemen. Sorry about that, ladies and gentlemen. So there it is. Buy setup, buy trigger, and here, 1, 2, 3, 4, 5 days in a row, you get an opportunity to establish the position. So talk about a reality-based webinar. You heard my dogs, and you probably heard my pool technician. So let's go on with a little bit more here. What I want to do is I want to focus on some recent trades. So I'm going to go through these charts. You can go through them on your own later on. Okay, here you go. Let me come back to some recent trades. Okay, here you go. Recent trades. Okay. Here's one that, sorry about that. Here's one that I'm in right now. Why? Here's the important thing. Remember what I said. It's all rule-based. Buy setup, buy trigger, bought the bottom of the channel. My target for today, the top of the channel, and that number is very clear right on the chart. So sometimes these will be a little bit more expensive than $15 a share. I make considerations for that. Let's go to the next one. And by the way, my target for tomorrow or today, right over here, probably won't hit the target, but that's okay. I've still got the trade going on. Here's another one. Alcoa. Notice, here's your 5-bar pattern. Here's your setup and trigger. The 5-bar pattern easily achieved over the next couple of weeks. The first opportunity to buy the bottom of the channel didn't happen until here. Top of the channel hit right over here, and several other opportunities to buy at the bottom of the channel, completely in accordance with the rules. Let's go on to the next one. APA, Apache Corporation. And I want you to notice something very important. Think. Buy setup, buy trigger. I'm not chasing the stock. I'm waiting for the stock to do what? To come down to the bottom of the channel. And please pay attention. Very important. At the end of this day, I know I want to be a buyer. I know the number I want to buy at, which is the green line. I look at the market before it opens, and what do I see? I see that it's trading all the way down here. I buy it immediately on the open and get a fantastic fill. Several days later, and by the way, I get opportunities the next 2 days as well if I didn't take this one. The same situation happens in reverse. I see that I want to get out here, but the market opens over here. I take my profit over there. I'm out of the trade. Got a beautiful fill getting in, a beautiful fill getting out. Now let me address another situation. This was a sell setup right over here. Did we have a sell trigger? No. Therefore, this trade is still active from the long side. In other words, it's still a buy at the bottom of the channel. You can see what happened today. We hit the bottom of the channel and had another opportunity to go long. In fact, we did so for the last several days, waiting for the target. Here's another one. This one turned bullish about a week ago with 2 bars above the top of the channel, and I'm waiting. Waiting for what? Waiting for my buy number to be hit. Has not been hit yet. And remember, I know everything I need to know about this trade. Where to get in, where to get out, my risk, my target, my trailing stop procedure. Let's look at another one. ZYNE. Buy setup, buy trigger, and I'm waiting. Let's look at another one. And again, waiting for what? And this is important. This chart was made about an hour ago, 2 hours ago. So the market is open. As the market is open, it continues to plot this green line. Remember that my order for today is the green line from the last completed bar, which was yesterday. So my order is down here, not up here. Very important. Remember that. Let's look at another one. Here's one. I want you to think about it before I say anything. Think. I'm going to wait. Now that you've had a chance to think about it and test yourself, I'll give you the answer. Buy setup. Buy trigger. How do I know that's a buy trigger? The lines look awfully close together. Remember, those lines are numbers. The numbers is what you want to look at. So if the lines are too close and you can't see it, look at the numbers. So I've got this coded to give me an indication when the lines are in cross mode. Very easy to do. So as of the day yesterday, it was a buy at the bottom of the channel from the previous day's number. And now it's at about a little bit of a losing position. We'll see how it turns out. I have one more for you, and that's right over here. Caesars. Look at the chart. Even though we went into sell setup mode, remember that a setup is not a trigger. Therefore, the only trades that have been made on Caesars have been from the long side. You wouldn't be making short trades anyway because of our rules, but the bottom line is opportunity to buy the bottom of the channel, opportunity to buy the bottom of the channel, get out at the top of the channel, and now it's long again as of today. So just let me review a couple of things for you. If you want to reach me, my email is jake@trade-futures.com. Hold on 1 second, let me go there. I'll be glad to answer any questions that you have. If you want to get the 3-part series, which covers what I did today, plus several weeks later and several weeks after that to see how these things turned out, total of 4.5 hours of video, I'll give it to you at a discount price. Just click the link and go there. The most important thing, and it doesn't matter to me whether you buy the video or not, is that you understand what I'm showing you. It's not perfect, but it is very effective, and it will keep you out of trouble if you follow the rules. So David or Anka, if there's any questions for me, you want to relay them to me. Otherwise, people can send me questions by email. I'm sorry about the noise. And most of all, I'm sorry for being late.